Welcome to Fatter Wallets Reads. We're the show that digs into the world's most influential books about money, business, investing, and mindset.
And today we're looking at one that's become really a cornerstone for anyone thinking about financial independence. It's The Simple Path to Wealth, Your Roadmap to Financial Independence and a Rich, Free Life by J.L. Collins.
Yeah, a really foundational text for so many people. And what's interesting is how it started, right?
Yeah.
It wasn't meant to be a big finance book initially.
Exactly. It actually grew out of a series of letters Collins wrote to his daughter. She was a teenager, and he wanted to give her a clear, simple way to navigate the financial world, cutting through all the jargon and complexity you usually find.
And you could feel that origin in the tone. That father-to-daughter advice gives it this very direct, no-nonsense power. His whole argument boils down to this. Investing successfully isn't actually complicated.
Right. He argues it's made complicated deliberately by the financial industry. Well, because that complexity, that confusion, that's where they make their money. You know, the constant noise from financial media, the fancy high-fee products, the endless parade of experts predicting the next crash or boom.
It keeps people uncertain and maybe paying for help they don't really need.
That's his point entirely. It keeps you feeling like you need them, keeps you paying fees. Collins himself reached financial independence pretty early using the exact simple methods he outlines. And his goal really is to give you that same clarity, that roadmap, so you can just ignore all the noise.
So if you're feeling, overwhelmed by all the investment options out there, this book basically says, stop. Here's the one path. Stick to it.
Pretty much. It's a very opinionated but very simple guide.
Okay, so let's dig into the core philosophy. What's the foundation of this simple path? It really starts with just 3 basic rules.
Yeah, 3 rules. And they sound almost too simple, like, is that it? But they are. 1, spend less than you earn. 2, invest the surplus. And 3, avoid debt like the plague.
Avoid debt. We'll definitely come back to that one.
Oh, yeah. He's very strong on debt. But following those 3, he insists, leads to wealth. And not just money wealth, but a rich, free life. That freedom part is key.
And central to this is how you view money itself. He says you have to master it, otherwise it absolutely masters you. He uses this great little parable, the monk and the minister.
Ah, yes. It's such a clear illustration of the mindset shift required. So you have this wealthy minister, fancy clothes, important guy, and he sees a monk just eating a simple bowl of rice and beans.
Okay.
And the minister, maybe a bit smugly, says, monk, if you just learned how to flatter the king, you wouldn't have to live on simple rice and beans. And the monk looks up and replies, well, minister, if you just learned how to live on rice and beans, you wouldn't have to flatter the king.
Oof, that hits hard. It's that fundamental choice, isn't it? Keep expanding your needs and stay dependent, or control your needs and gain your freedom much sooner.
Exactly. Cater to your needs or control them. And this leads directly to his warning about becoming what he calls a gilded slave.
Right, the gilded slave. Explain that.
It's when your lifestyle grows to match, or even worse, exceed your income. Even if you have a high income, if you need all of it to sustain your lifestyle, you're trapped. You're beholden to that job, that income source. The cage is gold-plated, maybe, but it's still a cage.
And being trapped like that makes it impossible to build real wealth or freedom. Which brings us back to debt. You said he's strong on this.
Extremely strong. He sees debt as the single biggest obstacle, the most corrosive force against building wealth. He doesn't pull any punches.
How bad does he make it sound?
He literally compares it to being covered in leeches, just constantly sucking your financial lifeblood away every single month. And crucially, he stresses that the cost isn't just the interest payments you see on your statement.
There's more to it than the numbers.
Absolutely. There's a huge psychological cost. Debt brings stress. It brings shame, guilt, a feeling of helplessness. It can really trap people mentally. Well, sometimes people get caught in this awful cycle where the stress of being in debt actually leads them to spend more money, maybe as a coping mechanism, retail therapy, which of course just digs the hole deeper. It damages your mental well-being right alongside your finances.
That's a grim picture. And this view requires us to challenge the idea of good debt, doesn't it? Things like student loans or mortgages.
Oh, definitely. He's deeply skeptical of the whole good debt concept. Let's start with student loans. The statistics he brings up are pretty jaw-dropping.
Like what?
Okay, get this. Between 1970 and 2014, general inflation in the U.S. went up about 6 times. 6-fold increase. Reasonable, but College costs.
Or,
Try 33 times, a 33-fold increase. It's just astronomical. And he argues that the easy availability of student loans, often government-backed, just flooded the system with money and allowed colleges to keep hiking prices with impunity.
wow. And there's a specific reason he calls students with loans indentured servants, right? It's about how the debt is treated legally.
Exactly. Unlike credit card debt or medical debt or most other debts, student loans are incredibly difficult, sometimes practically impossible to get rid of, even in bankruptcy.
So they stick with you.
They can follow you for decades, they can garnish your wages, even take chunks out of your Social Security payments down the line. So, from his perspective, aiming for financial independence, this kind of inescapable debt is just poison. A direct threat to ever being free.
Okay, so student loans are out, in his view. What about the other big one? Mortgages. Isn't owning a home the cornerstone of the American dream and a way to build equity?
He pushes back hard on that. He argues you should see buying a house not primarily as an investment, but as an indulgence, a lifestyle choice. And crucially, you shouldn't aim for the biggest, fanciest house you can technically afford.
So no McMansions.
Definitely not. He says you should seek the least house that comfortably meets your actual needs. Minimize that expense.
But hang on, isn't that ignoring some potential benefits? I mean, people talk about leverage, using the bank's money with a low fixed-rate mortgage. And there are tax advantages to home ownership. Isn't that a valid wealth-building strategy he's dismissing?
That's a really fair challenge, and it highlights the core tension in his philosophy. He doesn't deny the emotional appeal or the potential tax breaks of owning. But he always brings it back to the primary goal, achieving financial independence as quickly and simply as possible.
And a big house gets in the way of that.
Massively. A bigger house means way higher property taxes year after year. It means higher insurance costs, higher utility bills, much higher maintenance costs. He suggests budgeting at least 1% of the home's value every year just for upkeep.
Okay, those costs add up.
And the biggest cost, in his view, is the opportunity cost. All that money tied up in home equity and a bigger down payment and those higher ongoing costs, that's money that isn't invested in the stock market, specifically in something like VTSAX, compounding away for you.
So if your absolute priority is buying back your time, minimizing your biggest expense, which is usually housing, becomes paramount in his system.
Yeah.
It's a trade-off.
Exactly. Less house, more freedom, faster. That's the logic.
Understood. So for someone who is currently carrying debt, credit cards, student loans, whatever, what's the Collins strategy for getting out?
It's intense, laser-focused.
Blech.
The first step is to pay only the absolute required minimum payment on all your debts except one.
Okay.
Then you take every single spare dollar you can find, cutting expenses, maybe working extra hours, whatever it takes, and you throw all of it at the debt with the highest interest rate.
The most expensive one first.
Right. He calls this pouring fuel on the debt flames. Attack the highest interest one with everything you've got until it's completely gone.
And
Then you take all the money you were paying on that first debt, the minimum plus all the extra, and you immediately redirect that entire amount to the debt with the next highest interest rate. You create this snowball or maybe an avalanche of payment power rolling downhill.
And you keep doing that until all the debt is gone.
Yep. And the instant the very last debt payment is made, you don't suddenly have all this extra cash to spend. You immediately redirect that entire, now quite large monthly payment amount straight into your investment accounts. No pause. You pivot directly from debt destruction to wealth building.
That requires discipline.
Massive discipline, but it builds momentum.
Okay, so let's shift to that wealth building phase. The goal isn't just to be debt-free. It's ultimately about achieving what he calls FU money and financial independence, or FI. How does he define FU money? It sounds a bit aggressive.
It does, but it's not really about being aggressive to others. It's about reclaiming your own power and autonomy. FU money is having enough financial cushion that you have options. It's the ability to say no. No to a terrible boss. No to unreasonable demands. No to a project that violates your values. It's the freedom to walk away, or at least negotiate from a position of strength, not desperation.
He shares a personal story about this, right?
Okay.
Even with a small amount.
Yeah, it's a great little anecdote. When he was just 25, he'd managed to save up what he calls a princely sum of $5,000. Which doesn't sound like much, maybe.
Not world-changing now.
But for him, at that moment, in a job he really disliked, that $5,000 was enough leverage. It gave him the confidence to go to his boss and negotiate for 4 months of unpaid leave. He couldn't retire, obviously, but he could buy back a significant chunk of his time and control his life, even temporarily. That, he says, is the core power of FU money, even in small amounts.
Having options, having breathing room.
Exactly. And then the ultimate goal, full financial independence, or FI, has a very clear mathematical definition in his framework.
Which comes from the 4% rule, which
Mm.
we'll get into more detail on later, but the basic calculation for your FI number.
It's beautifully simple. You are financially independent when you have saved up 25 times your annual expenses in your investment portfolio.
25 times what you spend in a year.
Correct. If you spend $40,000 a year, your FI target is $1 million. If you live very frugally on $20,000 a year, your target is $500,000.
And this calculation immediately highlights where the real power lies in getting there, doesn't it? It's not necessarily about earning a massive income.
Not primarily, no. The most powerful lever you have is your savings rate, the percentage of your income you manage to save and invest. He gives this a really compelling illustration.
Let's hear it.
Okay, imagine someone earning a pretty modest income, say $25,000 a year, but somehow, through extreme frugality or maybe living very simply, they manage to save half of it, 50%.
So they live on just $12,500 a year.
Right. Tough, but possible for some. Their annual expenses are $12,500, so their FI target, 25 times that, is $312,500.
Okay.
Now, here's the kicker. Assuming historical stock market returns, he often uses around 11.9% for long-term growth in VTSAX. How long would it take that person saving 50% of their modest income to reach their $312,500 FI number?
I'm guessing quicker than most people think.
Much quicker, only about 11 and a half years.
Wow. From zero to financially independent in just over a decade on a $25,000 income just by saving half.
Exactly. That's the stunning power of a high savings rate. It radically compresses the time it takes to buy your freedom. Controlling your spending is often more impactful than just trying to earn more, especially early on.
That really drives home the monk's perspective, doesn't it? Master your needs first.
It absolutely does. And achieving that requires a significant mental shift in how you view money. The book outlines sort of 3 levels of thinking for an investor.
What's level I?
Level I is simply getting past the idea that money exists primarily for consumption. You have to stop thinking about money mainly in terms of what it can buy right now.
He uses that cautionary tale about Mike Tyson, the boxer.
Yeah, it's a stark example. Tyson earned something like $300 million over his boxing career, an absolutely staggering amount of money, and yet he ended up bankrupt.
How is that even possible?
Because, Collins argues, in Tyson's mind, money only had one purpose: to buy stuff. Cars, mansions, tigers, whatever. There was no concept of money as a tool for generating more money or buying freedom. It was purely about immediate gratification through spending. You have to break that link first.
Okay, so stop seeing money just as spending fuel. What's level 2?
The level 2 is when you truly internalize the concept of opportunity cost. And this one can be painful when you really grasp it.
Explain that. What is opportunity cost in this context?
It means that money you spend today isn't just gone. That's the obvious part. The hidden, much larger cost is the future growth that money would have generated if you had invested it instead. All those potential future earnings compounded over years or decades are also gone forever.
He calls it the evil twin of compounding.
That's the term, yeah. Because compounding can work for you spectacularly when you invest, but opportunity cost is compounding working against you every time you spend unnecessarily.
Can we make that more concrete? He uses a car example, I think.
Yes. Let's say you buy a new car for $20,000 more than a perfectly reliable used one would have cost. That extra $20,000 is gone. But let's assume you could have invested that $20,000 and earned, say, a reasonable 8% average annual return in the market over the long term.
Okay.
In the first year, the opportunity cost is $1,600 in lost potential earnings, 8% of $20K, but it doesn't stop there. In year 2, you lose another $1,600 plus the 8% return that the first $1,600 would have earned, and so on.
It compounds negatively.
Exactly. If you run those numbers out over, say, 20 years, that $20,000 extra you spent on the fancier car didn't really cost you $20,000. Factoring in the lost compounded growth, the true cost to your future wealth is closer to $93,000.
Wow. $93,000 for a $20,000 decision. That definitely reframes spending choices.
It's meant to. Every non-essential purchase carries this hidden long-term penalty. Understanding that is level 2 thinking.
So level 1, money isn't just for spending. Level 2, spending has huge hidden future costs. What's level 3?
Level 3 is about shifting your mindset when you look at your investments. You need to stop thinking of stocks or index funds as just numbers on a screen or slips of paper that bounce around based on the daily news.
What should you think instead?
Think like an owner. When you buy VTSAX, you are becoming a part owner of thousands of real operating businesses across America. These are living, breathing companies with employees, products, strategies, all striving to grow and succeed.
He uses Warren Buffett as the model here.
Yes, during the massive financial crisis of 2008-2009, Warren Buffett's personal net worth on paper dropped by something like $25 billion. A mind-boggling number.
Most people would panic, sell everything.
Right. But Buffett didn't panic. Why? Because he wasn't just looking at the stock prices. He knew he still owned the exact same shares in the same collection of solid, profitable businesses like Coca-Cola, American Express, etc. The market price was temporarily down, reflecting fear, but the underlying value of the businesses he owned hadn't evaporated. That owner's perspective gives you the mental fortitude to ride out the storms.
That makes sense. Having that owner's mindset, that long-term view, is probably essential to actually stick with the investment plan he recommends, which is incredibly simple.
Almost shockingly simple. He basically says your entire investment toolkit needs only 3 things.
Just 3, what are they?
VTS, AX, VBTLX, and cash. That's it.
Okay, let's break those down. VTSS.
VTSAX is the ticker symbol for the Vanguard Total Stock Market Index Fund Admiral shares. It's a mutual fund that aims to track the performance of the entire U.S. stock market.
How does it do that?
By holding small amounts of stock in basically every publicly traded company in the U.S., thousands of them. From the giants like Apple and Microsoft all the way down to much smaller companies, you're not picking winners, you're buying the whole haystack. Maximum diversification within the U.S. market.
And VBTLX.
That's the Vanguard Total Bond Market Index Fund Admiral shares. Same idea, but for bonds. It holds a huge variety of U.S. investment-grade bonds, government bonds, corporate bonds, etc. It represents the broad U.S. bond market.
And cash is just cash.
Yep. Regular cash held in a savings account or money market fund, primarily for your emergency fund, 3 to 6 months of living expenses, and for any known large expenses coming up in the very near future where you can't risk market fluctuations.
So stocks for growth, bonds for stability, cash for immediate needs. That's the entire portfolio structure.
That is the entire structure. No individual stocks, no international funds in his core recommendation, no sector bets, no commodities, no crypto, just total U.S. stock market, total U.S. bond market, and cash.
Why VTSX specifically? Why not an S&P 500 fund, which holds the 500 largest U.S. companies? That's very common, too.
That's a good question. An S&P 500 fund is also a great low-cost option, and the performance difference historically hasn't been enormous. But Collins prefers the total market approach because it includes thousands of additional small and mid-cap stocks.
Does that make a big difference?
Over long periods, small-cap stocks have sometimes provided slightly higher returns, though with more volatility. By including them, VTSAX gives you exposure to potentially faster-growing smaller companies that might become the giants of tomorrow. It's just slightly broader diversification. But honestly, for most people, the difference between VTSAX and a good S&P 500 index fund is minor compared to the main point,
which is
the indexing itself and the low cost. And that brings us to why he emphasizes Vanguard so heavily.
Right. It's not just the index funds, it's the provider. Why Vanguard?
This is absolutely critical to his whole argument. Vanguard has a unique ownership structure. Unlike pretty much every other major investment company, which is owned by external shareholders and aims to make a profit for them, Vanguard is owned by its own funds.
Owned by the funds. How does that work?
It means the funds, and therefore the people invested in the funds, that's you, the investor, are effectively the owners of the company. This structure allows Vanguard to operate essentially at cost. Their goal isn't to maximize profits for outside owners, it's to keep costs as low as possible for the fund investors.
So their interests are aligned with the investors' interests.
Perfectly aligned. They want low fees because you want low fees. This is radically different from a typical financial company that makes more money when they charge you higher fees.
And this translates into real numbers.
Big time. Collins often points out that Vanguard's average expense ratios, the annual fee you pay for holding a fund, are dramatically lower than the industry average, maybe something like 0.1% or even less for their broad index funds, compared to an industry average that might be closer to 1% or even higher for actively managed funds.
1% doesn't sound like a huge difference.
But remember, opportunity cost and compounding. That difference of, say, 0.9% per year might seem small initially, but over 20, 30, 40 years of investing, that fee difference adds up to potentially hundreds of thousands, even millions of dollars that stay in your pocket, compounding for you instead of going to the fund company. Low cost is paramount.
Okay, so the structure makes Vanguard uniquely investor-friendly, and the strategy is indexing. What's the evidence that indexing is actually better than trying to pick winning stocks or funds?
The evidence is overwhelming and consistent over decades. Study after study, including data call-in sites from Vanguard and others, shows that the vast majority of professional, highly paid, active fund managers fail to beat their relevant market index over the long term.
Really? Even the pros can't beat the average.
Most of them can't, especially after you factor in their higher fees. He quotes a statistic like 82% of active U.S. stock fund managers failed to beat their index benchmark over a recent 15-year period. Think about that. You have a less than 1 in 5 chance of picking a professional manager who will actually outperform the simple, cheap index fund.
So trying to beat the market is likely a losing game.
Statistically, yes. Indexing isn't settling for average. It's practically guaranteeing yourself a top quartile performance relative to other investors simply by capturing the market's return at an extremely low cost. Collins argues it's not the lazy way, it's the smartest, most efficient way for the vast majority of people. You save time, you save stress worrying about picks, and most importantly, you save a fortune in fees.
This all hinges on a core belief he holds about the market itself, doesn't it? That over the long haul, it reliably goes up.
Absolutely. That's the bedrock assumption. He argues there are fundamental reasons why the stock market, representing broad business activity, has an inherent upward bias over time.
What are those reasons?
2 main ones. First, the market is self-cleansing. Think about it. When big companies fail spectacularly like Enron back in the day, or Blockbuster, or Sears, they eventually fall out of the index. They get replaced by new, innovative, growing companies.
So the losers get kicked out.
Right. And critically, the maximum you can lose on any single stock is 100% it goes to zero. But the potential upside for the winners, the next Google or Amazon or whatever comes next, is theoretically unlimited. This asymmetry limited downside for losers within the index, unlimited upside for winners, constantly pulls the overall average upward over time.
That makes structural sense. What's the second reason?
The second reason is more fundamental. Stocks aren't just ticker symbols. They represent ownership in living, breathing companies. Companies filled with smart, driven people who are constantly competing, innovating, trying to grow profits and create value in order to survive and thrive.
Human ingenuity and competition driving growth.
Exactly. It's the engine of economic progress. And if you look at long-term historical charts of market indices like the Dow Jones Industrial Average going back over a century, the pattern is undeniable. You see huge crashes, the Great Depression, World Wars, the dot-com bust, the 2008 crisis, pandemics, massive, terrifying drops. But the long-term trend through all of it is relentlessly upward.
So the argument is, if you have a long enough time horizon, history is overwhelmingly on your side.
That's the core belief, which then dictates how you should react to market volatility and crashes.
Which he says are inevitable, right? Like bad weather.
Totally normal. He compares market crashes to blizzards in winter. You know they're coming eventually, you don't know exactly when, but you don't panic and sell your house every time it snows. You prepare, and you ride it out.
So when the market plunges 20%, 30%, 40%, what's the advice?
Toughen up. Seriously, that's his advice. Develop the mental fortitude to stick to your plan. And importantly, if you are still in the accumulation phase, meaning you are still saving and investing, years away from needing the money. A market crash is not a disaster, it's a sale. It's a fantastic opportunity. Every dollar you invest during a downturn buys you more shares of VTSX at a lower price. You should almost welcome crashes during your working years as they allow you to accelerate your accumulation.
That's a hard mindset shift for most people, seeing a crash as a good thing.
Very hard. It goes against every instinct. But it's crucial for long-term success with this strategy.
Okay, so the strategy does differ slightly, depending on whether you're accumulating wealth or preserving it, right?
Yes, there's a distinction. For someone young, maybe in their 20s or 30s, with decades until they need the money, he recommends the most aggressive path.
Which is?
100% VTSAX. All stocks, all the time. Maximize growth, because you have decades to recover from any downturns. Time is your biggest ally, so you put it to work in the highest growth potential asset class.
But what about when you get closer to retirement, or you're actually retired and need to start drawing money out? That sounds risky to be 100% stocks then.
Exactly. That's when you shift into the preservation phase. As you approach the time you'll need to start spending your investments, or once you're already living off them, you need to dial back the risk and add stability.
And that's where the bonds come in. VBTLX.
That's where VBTLX comes in. Bonds generally have lower returns than stocks, over the long run, but they are much less volatile. They act as a shock absorber for the portfolio. When stocks plunge, bonds often hold their value or even go up slightly, providing a stable source of funds you can sell from instead of selling stocks at low prices.
So what kind of mix does he suggest for preservation?
There's no single magic number, but a common allocation he discusses might be something like 75% VTSOX stocks and 25% VBTLX bonds, or maybe even leaning more conservative like 60/40 or 50/50 stocks to bonds, plus maybe keeping 5% or so in cash for immediate withdrawal needs.
So you give up some potential upside from stocks.
In exchange for a smoother ride and less risk of having to sell low during a downturn when you need the income. It's about reducing volatility when your withdrawal timeline is shorter.
Okay, that makes sense.
Right.
So you followed the plan, you've accumulated your 25 times annual expenses.
Yeah.
Now, how do you actually live off it? This brings us back to the 4% rule.
Yes, the famous 4% rule. It's really the linchpin of the whole financial independence movement, giving people a concrete target and a withdrawal strategy.
Where did it come from?
It's based largely on academic research, most famously the Trinity study from the late 90s, which has been updated and analyzed many times since.
And what did that study find, essentially?
It looked back at historical market data over many decades, testing different withdrawal rates from different portfolio mixes, stocks versus bonds. The key finding was that withdrawing 4% of your initial portfolio value in the first year of retirement, and then adjusting that dollar amount upward for inflation each subsequent year.
Yeah.
That strategy had a very high probability of success, meaning the portfolio didn't run out of money over its 30-year retirement period, even through historical market crashes. For a balanced portfolio, often modeled as 50% stocks and 50% bonds, the success rate was around 96%.
96% chance of the money lasting 30 years. That sounds pretty solid.
It does sound incredibly reliable, but, and this is a huge but, it's not a guarantee. And there's a major risk hidden in that 4% average success rate.
What's the risk?
It's called sequence of returns risk, sometimes abbreviated SRR.
Sequence of returns risk. Okay, what does that mean?
It means the order in which you experience market returns matters hugely, especially right after you retire. If you're unlucky and experience a big market crash, say down 30% or 40% in the first few years after you stop working and start withdrawing money, it can be devastating. Even if the market delivers great average returns over the next 30 years, taking those 4% inflation-adjusted withdrawals out of a severely depleted portfolio early on forces you to sell way more shares when prices are low. This can cripple the portfolio's ability to recover, significantly increasing the chance it runs out of money later, even if markets eventually boom.
So a bad sequence right at the start can sink the whole plan, even if the long-term average returns are fine.
That's the danger of SAR, yes. The 4% rule's historical success rate averages out good and bad starting sequences, but if you happen to hit a bad one, that average doesn't feel very comforting.
So if the rule isn't foolproof, what provides the real security in retirement, according to Collins?
He stresses this point repeatedly. True financial security in retirement doesn't come from a rigid rule. It comes from flexibility.
Flexibility in what?
Flexibility in your spending. The most secure retirees are those who have the ability and the willingness to temporarily tighten their belts if the market tanks early in their retirement. Maybe instead of taking out 4% that year, they only take out 3%, or even 2.5% if they can manage it.
By cutting back temporarily.
Exactly. By reducing withdrawals during a major downturn, you avoid selling assets at bargain basement prices. You give the portfolio a chance to recover when the market eventually turns around. That flexibility to adjust spending in response to market conditions is far more powerful protection against SAR than relying blindly on the 4% number.
Okay, so the 4% is a good starting guideline, but be prepared to adjust downwards if necessary. And there's another absolutely critical factor for making the 4% rule work at all, which ties back to something we discussed earlier.
Fees. Low costs.
Yeah.
Yes, this cannot be overstated.
How much do fees impact the 4% rule's success?
Dramatically. Collins points out that the original Trinity study calculations implicitly assume very low investment costs, like those you'd get with Vanguard index funds. Remember that 96% historical success rate for a 50/50 portfolio. If you introduce a typical, seemingly modest 1% annual AUM fee from an advisor, or high expense ratios from active funds, that 96% success rate plummets. Add a 2% total fee drag, which isn't uncommon in the traditional financial world.
What happens then?
The historical success rate drops to something like 65%, maybe even lower depending on the study and assumptions.
Wow, just a 2% fee cuts your chances of success by almost a third.
It's devastating. That 2% you're paying every single year is money that's not only gone, but it's money that's not compounding for you. Over 30 years, the impact is enormous. It completely undermines the mathematical basis of the 4% rule. Following Collins' low-cost VTSAX VTLX approach is essential for the withdrawal strategy to have a high probability of working.
Keep costs microscopic.
Got it. Okay, one last layer of practical strategy. Taxes. We have these simple investments, VTSX and VBTLX, but we need to decide where to hold them and which types of accounts.
Right, the tax buckets, as they're often called. You've got your tax-deferred accounts like traditional 401ks and IRAs, your tax-free accounts like Roth 401ks and Roth IRAs, and your regular taxable brokerage accounts. The goal is tax efficiency.
Meaning putting the right type of investment in the right type of account.
Exactly. You want to shelter the least tax-efficient investments inside your tax-managed accounts, the 401ks and IRAs, as much as possible. Which of VTSX or VBTLX is less tax-efficient?
Bonds VBTLX are generally less tax efficient. Why? Because the return they generate comes primarily in the form of interest payments. And that interest is typically taxed as ordinary income, which is usually your highest tax rate. Plus, you usually owe that tax every year, even if you reinvest the interest.
So, if possible, you want bonds inside a traditional 401k or IRA where the interest grows tax-deferred until you withdraw it in retirement.
That's the ideal placement for bonds, yes. Shelter that tax-inefficient interest income.
And stocks, VTSX.
Stocks are generally more tax efficient. A large part of their return comes from growth in the share price, capital appreciation. You only owe tax on that capital gain when you actually sell the shares, and if you've held them for over a year, it's usually taxed at lower long-term capital gains rates. VTSAX also throws off some dividends, which are usually taxed favorably, but the main tax burden is deferred until sale.
So VTSX can be held reasonably well in a regular taxable brokerage account.
It can, yes. While putting it in a Roth account, where all growth is tax-free forever, is the absolute best if you can, VTSAX is efficient enough that holding it in a taxable account after your tax-advantaged accounts are full is perfectly fine and often necessary for early retirees who need access before age 59 and a half.
This leads to a specific order, a hierarchy for filling up these different tax buckets each year, right?
Yes, there's a clear recommended sequence to maximize the benefits. First, contribute enough to your workplace 401k or equivalent plan to get the full employer match. That's free money and instant guaranteed return. Never leave that on the table.
Step 1, get the match.
Step 2, if you're eligible, fully fund your IRA, either a traditional IRA for an upfront tax deduction or a Roth IRA for tax-free growth and withdrawals. Roth is often preferred if you expect to be in a higher tax bracket in retirement, but either is good. IRAs often offer more investment choices and potentially lower fees than 401k.
Okay, match first, then Roth IRA.
Step 3, go back to your 401k and contribute more until you hit the annual maximum contribution limit allowed by the IRS. Max out that tax-advantaged space.
Max out the 401k.
Step 4, only after all those tax-advantaged accounts are completely maxed out should you direct any remaining savings into a regular taxable brokerage account holding tax-efficient funds like VTSAX there.
Got it. Match, IRA, rest of 401k, taxable. That's the funding order. One final piece related to retirement income. Social Security. What's the advice there?
His advice is pretty blunt. Plan your FI number, that 25 times expenses calculation, completely ignoring Social Security. Don't count on it being there in its current form when you need it.
Assume it's zero for planning purposes.
Essentially, yes. That way, if it does come through for you, it's just a bonus, extra gravy, maybe allows for more discretionary spending or leaving a larger legacy. But your core financial independence shouldn't rely on it.
But if you are expecting it, are there strategies to maximize it?
The main strategy involves when you claim benefits. You can claim as early as 62, but your monthly payment will be significantly reduced. For every year you delay claiming past your full retirement age, up to age 70, your benefit amount increases substantially.
So delaying pays off.
Generally, yes, especially if you are relatively healthy and expect to live a long time. Delaying until age 70 usually maximizes your lifetime payout. This is particularly important if you are married, as delaying the higher earner's benefit until 70 also maximizes the potential survivor benefit for the spouse if the higher earner dies first.
Okay, plan like it's zero, but if optimizing, delaying to 70 is often best. Makes sense. All right, we've covered the core concepts of the simple path. Let's shift now to a bit of critique, a balanced perspective. What's the undeniable value here? What makes this book resonate so much?
I think the fundamental brilliance, as we touched on, is tying the simple strategy to the Vanguard structure. It's not just buy index funds. It's buy index funds from a place that's owned by you and operates at cost. That alignment of interests is incredibly powerful and rare in finance. It makes the simple path structurally sound.
And beyond this structure, there's a philosophical power too, right?
Absolutely. The book serves as this incredibly effective antidote to what feels like constant financial brainwashing from the media and the industry.
Mhm.
The endless noise about stock picks, market timing, complex strategies, it all serves the industry's need to seem necessary and charge fees. Collins just cuts through all that like a laser. He basically says, ignore all of it. It's designed to distract you and cost you money.
It empowers the individual to take control simply.
Exactly. It gives you permission to ignore the noise and follow a clear, evidence-based path.
Okay, but no approach is perfect. What are the limitations or the biggest challenges with this simple path?
The biggest limitation isn't in the strategy itself, which is mathematically and historically sound. The limitation is us. It's human psychology.
Sticking with the plan.
Sticking with the plan when things get really scary. The strategy requires immense mental toughness, what Collins calls getting your mind right. It's one thing to read the book in a calm market and nod along, saying, yeah, I'll hold 100% VTSAX through thick and thin.
But it's another thing entirely. When the market has crashed 40%, your account value is down hundreds of thousands of dollars. Maybe your job feels insecure, and every single news headline is screaming, sell, get out.
Precisely. That's when the emotional brain takes over. The urge to just stop the bleeding, to time the market sell low and wait for things to feel safe again before buying back high is incredibly powerful. And that's the single biggest destroyer of wealth for most investors.
Collins calls market timing a loser's game, right?
He does. He argues that only a tiny fraction of people, maybe 1%, can do it successfully, even for short periods, and almost no one can do it consistently over the long term. Trying to dance in and out of the market usually just leads to missing the best recovery days and racking up transaction costs or taxes. Sticking to the simple buy and hold plan, especially during crashes, requires a level of emotional discipline that's frankly very difficult for most humans to maintain without practice and conviction.
So the simplicity is deceptive. Simple to understand, hard to execute emotionally.
That's the core challenge. He also takes a somewhat controversial stance against dollar cost averaging, or DCA.
Right, DCA is when you have a lump sum of money, maybe from an inheritance or bonus, and instead of investing it all at once, you invest it in smaller chunks over several months. The idea is to avoid the bad luck of investing everything right at a market peak. A lot of people recommend that.
They do, often for psychological reasons. But Collins argues DCA is essentially just another form of market timing, driven by fear. His logic is statistical. Since the stock market goes up more often than it goes down historically, something like 77% of the time, then delaying your investment means you are statistically more likely to be missing out on gains than avoiding losses. Therefore, lump sum investing, getting all your available money into the market working for you as soon as possible, is mathematically superior most of the time.
But what if someone just can't stomach investing a huge amount all at once? The fear of an immediate crash is too great.
He acknowledges that reality. He basically concedes that if using DCA is the only way you can psychologically commit to getting the money invested according to your plan, then fine, do it. Consider it a small price you pay, and potentially lower returns, for the mental comfort needed to stay invested. But recognize it is a trade-off against the statistically optimal approach.
Understood. Lump sum is better math. DCA might be better psychology for some. Finally, let's circle back to his critique of investment advisors. It's quite pointed. Many listeners might work with an advisor or feel they need one.
It is very pointed. And again, his argument comes down to the structure of the industry and conflicts of interest. He contends that the way most advisors get paid inherently pits their interests against yours.
How so?
Most advisors are paid either through commissions on the products they sell you, these are often called loads, hidden sales charges, or through a fee based on a percentage of your assets under management, AUM, typically around 1% per year.
We already discussed how damaging that 1% AUM fee can be to long-term return.
Exactly. And if an advisor is paid by commission, they have a direct incentive to sell you products that pay them the highest commission, regardless of whether those products are actually the best or lowest cost option for you. Often, complex high-fee funds or insurance products pay the highest commissions.
So the incentive is to recommend complexity and high fees, not simple low-cost index funds like VTSAX.
Precisely. Why would a commission-based advisor recommend VTSAX when they make little or nothing from it? And even AUM advisors, while perhaps less conflicted than commission-based ones, still benefit from managing more complex portfolios that seem to justify their ongoing fee. Their fee directly reduces your returns.
So his conclusion is pretty stark.
His conclusion is essentially, by the time you've educated yourself enough about investing principles, about the importance of low fees, about fiduciary duty, which means an advisor is legally obligated to act in your best interest, and about index funds to be able to identify a truly good fee-only fiduciary advisor who would recommend a simple, low-cost plan.
Yeah.
You probably know enough to just implement that simple plan yourself using Vanguard and skip the advisor fee altogether. You've become your own best advisor for this specific, simple strategy.
The takeaway being, don't pay someone a percentage of your wealth year after year just to tell you to do something incredibly simple that you can do yourself in a few clicks.
That's the essence of his critique. Be very wary of conflicts of interest and the drag of fees.
Okay, that's a comprehensive look at the book and some perspectives on it. Let's distill this down into the key actionable takeaways for listeners. We like to frame these around clarity, confidence, and stewardship. It's the first big one.
I think the first is clarity. Master your needs, then your money. This really gets to the heart of it. Financial freedom starts with controlling your spending, embracing the monk's path even more than it starts with chasing high returns. Understand the 25x annual expenses rule for FI, and internalize that every single dollar you spend has a potentially massive opportunity cost down the road. Remember that $20,000 car potentially costing $93,000. That clarity changes behavior. Get off the consumer treadmill first.
Excellent. Clarity on needs and costs. What's the takeaway for confidence?
Confidence. Indexing is the smartest default. This is about humility and evidence. Stop thinking you need to find the next hot stock or pay someone else to. The data overwhelmingly shows that consistently investing in a low-cost, broad-based index fund like VTSAX will likely put you in the top tier of investment results over the long run, with far less effort, stress, and cost. Have the confidence to accept the market's return, because trying to beat it is usually a recipe for underperformance and higher fees. Trust the simple, proven path.
Simple is smart. Got it. And the third takeaway around stewardship.
Stewardship. Debt elimination is an emergency. This is about taking responsible control of your financial foundation. Don't normalize carrying high-interest consumer debt or even large amounts of student loan debt if you aspire to FFI. See debt, especially costly debt, as a financial crisis that requires immediate, intense action. Use that debt flame strategy, attack the highest rate first with everything you have. Get to zero debt, potentially excluding a reasonable mortgage, depending on your goals, as fast as possible, then immediately pivot that repayment intensity towards investing. Steward your resources by eliminating leaks first.
Clear your debts with urgency. And maybe one more practical action challenge.
Let's add action challenge. Fund your buckets to the max. Take deliberate action to use the tax system to your advantage. Follow that strict funding hierarchy we discussed. 1, get the full 401k match. 2, max out your IRA or Roth IRA. 3, max out the rest of your 401k. 4, then and only then, invest in a taxable account. Consciously shielding your investments from taxes as much as legally possible significantly boosts your long-term compounding. Maximize those tax-advantaged buckets every year.
Perfect. Master needs, trust indexing, eliminate debt urgently, and max your tax buckets. That really captures the essence of the simple path.
It's a powerful combination. Simple, but not necessarily easy to stick with.
Indeed. Well, if you enjoyed this look at the simple path to wealth on Fatter Wallets Reads, please make sure to subscribe so you don't miss future summaries. And visit us at fatterwallets.com. You'll find more content, tools, and insights inspired by great financial books to help you on your own Fatter Wallets journey.
And maybe a closing thought to leave you with. Really think about what that FU money truly means for you. It's maybe not about rage quitting your job tomorrow. It's about options. It's about freedom. It's about gaining the power to say no when you need to and yes to the things you truly value. Maybe that's spending uninterrupted time building Lincoln log cabins with your kids like Collins did. Maybe it's traveling. Maybe it's pursuing work you love, even if it pays less. It's about knowing that your money, invested simply and effectively, is working diligently in the background, compounding harder than you are, buying back your time day by day. What would you do with that freedom?